Good day, fellow investors. Now, Potomac asks a great question here. The T-bill and chill investment strategy has been promoted everywhere. I have two problems with it. One is a general. When something is too obvious, it's obviously wrong. Other is that governments don't have either the willingness or possibility to pay investors any real returns. And I don't know how they will handle this devaluation, but there is most certainly a need for that, of course, of the currency. So long stocks with real asset characteristics, okay, I might disagree on gold and Bitcoin, fixed interest rate mortgage from the bank with real estate backing, of course. So, a very interesting topic that I want to discuss here because Buffett is also buying a lot of T-bills, so there must be something there. I always like to watch what Warren Buffett is doing, not what he is saying, and we'll see later with the data from Berkshire that he has been just sticking to T-bills, which could mean that he is expecting a crash, cheaper stocks, and therefore he prefers to wait even for zero real returns, as we will see. Timing the market, you might call it that way, but it is also seeing how you manage a portfolio, what is the risk you want to take in that portfolio, and Warren Buffett is now lowering the risk by increasing the T-bill and chill investment strategy. And if we look at the current yield on US Treasuries, Warren Buffett is always going for an average of 3 months, which means he is getting 5.4% on his 170-80 billion, which is almost 10 billion, let's say $8 billion per year he's getting now just from the US government. So, saying about giving to the poor, well, that's how it goes when you have loans. But Potomac is totally right. The real return, when you look at inflation and the interest rate, the real return is still zero. It is much better than it was, almost 5% a while ago, but it's much worse than it was historically, with always a real yield of 2% in the past, 3% excluding the zero real yields over the last decade and something. But you are still practically doing nothing even by getting 5%. And we have discussed this with the JPM market overview. I'll put the link in the description below, how none of the fundamentals justify the current market. Look at that for government, economy, and everything. And then you might think, okay, zero might not be that bad. But it is zero. You don't make any money. But think from a value investing perspective. You get zero, but what is the risk? And you have to always compare, first focus on the risk, and that is also what is Buffett doing. I'm not making anything here with zero, but I'm not also losing anything. And that is one thing that, okay, people maybe are now focused on not taking risks, and that is never wrong. So I have to disagree a little bit here with Potomac. But on the other hand, he is extremely correct with the behavior of governments. We discussed this with Druckenmiller's video, where he's saying that the fundamentals of the government, the budget, are simply not working long term. So they are just pushing the can down the road, but this cannot work forever. Therefore, real returns, even at 5%, are just vague in the future. So people think that locking in higher rates now will lead to lower rates in the future and make them making money, but who knows whether there will be. It will be volatile, I think, but hardly that there will be any real returns for the long term. So I think this could be interesting, the T-bill and chill, if you don't have any other options now. But as soon as other options arise, then it is time to hit the other options. So it's T-bill and chill. I say T-bill and wait, not T-bill and chill, definitely not. So just to park money. And that is exactly also what Warren Buffett is doing. Let's discuss Berkshire and the numbers. The recent 10Q is out, so nothing wrong with Berkshire. They made huge money. Insurance investment income is booming because of the higher yields. Everything is good. Other businesses are stable, so nothing wrong there. And you can see that Buffett has more and more cash. So if we look at the cash equivalents position, the last data shows that there is 173 billion of cash compared to 9 months ago, 154 billion of cash. And if we look at the cash flow statement, you can see that the purchases of securities versus sales of securities show us a net sales of $23 billion for the first 9 months. So this is the things that Warren Buffett is doing. Unlike last year, when it was a 50 billion positive, he was buying stocks for 50 billion. Here he is selling stocks. So he has been selling for the year. Buybacks are way lower than those were in the last 3 years. He bought a business here, okay, or some other business bought something, but in general, he is trimming his stock portfolio and piling up cash. Of course, he is not selling his apples, his Coca-Colas. That's something he doesn't do. When there is too much risk in the market, Buffett doesn't sell anything. He just trims a little bit the risk exposure and holds more cash for potential opportunities. Opportunities that should arise if there is a crash. And if Buffett is preparing for a crash, he says that it's better to be prepared for a crash rather than being invested in assets that are actually risky. And now the question is there a market crash coming ahead? Well, the fundamentals are generally bad. High debt levels, government issues, higher interest rates that should push earnings down, recession, slowing economy, and also if you get 5% from treasuries. Historically, the case has been that you need to get 7.5% from stocks. But if I look at the earnings yield from stocks, it is 4%, the earnings yield. If that earnings yield goes to 7%, which should be something to expect, if you can get 5% risk-free from treasuries, at least a 200 basis point spread should be there as the risk equity premium. If that happens for stocks, that means 2,716 points from the current 4,400, and that's a 40% drop in stocks if stock prices adjust to the current stock market interest rate situation. If that happens, 40% down is something that can happen. What's the reward with stocks? Well, you have to think that the earnings yield, given that earnings will likely be sluggish, the earnings yield should go to 3%. But why should the earnings yield go to 3% if we are in an environment of 5% interest rates? So, of course, it is impossible to time, but Warren Buffett at 93 years old is patient. So, if he can be patient and slightly adjusting the risk exposure of his portfolio. A year ago, he was saying, we are buying because it's better than holding money in bonds. Now, he's not saying, now, last year he was buying Occidental and everything. Now, he's saying, it's better to keep my cash in bonds at these interest rates. So, as always, we learn from Buffett, we watch what he does. Okay, here and there it's fun to hear what he says, but always watch for what he does, as he's always very, very prescient with that. Just small risk trimming in his portfolio that will allow better purchases in case there is a crash going forward. And then again, if you buy lower, your returns long-term are automatically higher. That's what Warren Buffett is doing. Thanks for watching, see how it fits your portfolio, and I'll see you in the next video.